So hi everybody, welcome to today's accounting design project. We have Xiaoxi Wu from Bocconi University today to talk about non-GAAP earnings guidance. Xiaoxi, you have 1 hour. Yeah.
Thank you. So I want to thank the organizers for including the paper, which is titled Implicit Non-GAAP Earnings Guidance, and it is co-authored with Kalin and Edgar at Baruch, who are wonderful co-authors and experts on non-GAAP reporting. So let me dive into the paper and start talking about the motivations for the study. So essentially, we all know non-GAAP earnings, they're a very important measure of core performance, and they're widely used in forecasting and valuation activities. And in the guidance literature, there are several papers looking at how managers use management guidance on non-GAAP earnings in order to influence how financial analysts essentially define their street earnings forecast. But then when you think about overall the proportion of firms that actually do guide on non-GAAP earnings, things get interesting in a sense that the majority of companies, they actually do not guide on non-GAAP earnings nowadays. So a recent survey by Call and co-authors, essentially they find more than half of the companies do not provide guidance on non-GAAP earnings or what we call street earnings from the analyst perspective. So this puzzle led us to the motivating question we have in mind, which is how do managers convey their expectations of core earnings when they do not explicitly provide non-GAAP earnings guidance? So to understand how companies do this, we essentially started, reading the company disclosures, trying to figure out if there are other types of forward-looking information that could form the expectation of non-GAAP earnings. And then what we see companies do in their voluntary disclosure is that sometimes even without explicit guidance on non-GAAP earnings, managers would just separately give guidance related to single, say, special items or other recurring items and communicate the expectation about that to the market participants. So here on the screen, we have an example where Harley Davidson essentially, without guidance on non-GAAP earnings, telling the market participants at earnings conference call that they expect to have restructuring charges that's going to impact their financial statement. And with this observation in mind, we also actually talked to some real life sell side analysts to essentially get their view on whether they think it's common or not. And they essentially confirmed to us that they actually see in reality quite common that some managers they don't really guide on non-GAAP earnings, but they would just guide on the individual special items and recurring items to help analysts form their street earnings forecasts. So then this led us to our specific research questions, which is related to implicit non-GAAP earnings guidance. And we define in our study implicit non-GAAP earnings guidance as management guidance on individual special items and recurring items that are often not considered part of a firm's core earnings. And we call this SIRI guidance to make it catchy. And specifically, managers do this without giving explicit non-GAAP earnings guidance. So surrounding this concept, we essentially want to address 3 research questions. The first research question is fairly descriptive. It's just to see to what extent do managers provide implicit non-GAAP earnings guidance. And then the second and third research questions move forward to touch on hopefully the economic intuition behind this phenomenon. So we want to study whether implicit non-GAAP earnings guidance can influence how analysts forecast street earnings. And then we want to understand with the third research question, from the manager's perspective, what are the relative costs and benefits of giving implicit non-GAAP earnings guidance instead of a very explicit non-GAAP earnings guidance. So at a very high level,
Xiaoxi,
yes.
may I ask you questions about the research question that you have
Yes.
it on the motivating and then this question. So in this series and then the last fall, we have a couple of non-GAAP papers. And then I think the discussion usually led to what exactly is the theoretical construct of non-GAAP. And looking at your more kind of narrower definition of explicit versus implicit, it sounds like you are capturing individual line item guidance versus a summary statistics that net out a number of line items, right? And is that something that you and your co-authors have in mind? Is that whether firms actually giving some, for example, restructuring cost guidance, that would be a kind of like a particular line item guidance, or some combination of special items across restructuring costs, asset write-off guidance, and that would be a bundle of a different line items. Is that something kind of you have in mind?
Yeah, so essentially, empirically, what we're capturing as the Siri guidance, it could be if a firm just guide on one special item, or it could be if a firm has many things going on, it could be a bundle of guidance, including both special items and other recurring items that people often consider as non-GAAP. So we are capturing all of those situations, but then our focus is we want to study whether the guidance on those special or recurring items, whether it is informative when managers do not explicitly accompany that with a non-GAAP earnings guidance. So managers only guide on the individual lines or one individual line, but then managers do not explicitly say, then I also give you the non-GAAP earnings guidance for the next year. So that's what we have in mind in terms of implicit non-GAAP earnings guidance. But then, of course, later on, we need to go on and validate this assumption and then show its informativeness.
I see.
Xiaoxi, just a follow up there. Do you ever see firms in this implicit guidance excluding, say, depreciation and amortization and interest, which is usually the big ones in the non-GAAP numbers?
So we have, let me just very quickly jump ahead a little bit. So essentially, we are using a novel data set on management guidance, which captures a very broad range of consolidated financial statement items. And from this data set, what we did was we follow the prior non-GAAP literature, and then we essentially got a very big list of special items and other recurring items that firms typically exclude, or analysts they typically consider as non-GAAP, non-core. Then we essentially compare that list with the guidance item list, and then we pick out then we just pick out all the special items we see and all the recurring items we see, and then we call those things Siri guidance. So you can see here on the screen, for special items, we have 9 individual line items. So as long as a firm guides on one or more of those, then they're considered to be given a guidance on special items. And then for recurring items, we have 4 different items. So all those together, we call them guidance on Siri.
I think Brett Johnson has a question as well.
Yeah, thank you, Xiaoxi. So you're very careful, I think, to separate the cases where there's also explicit non-GAAP guidance, correct? And so you have these Siri items in the absence of a full non-GAAP guidance number. Is there variation in a GAAP forecast? In other words, GAAP guidance that managers are putting forward?
Yes. So I think if you're okay with it, I'm gonna defer this
That's
question
fine.
because we have a cross-sectional analysis where we label it as there are different levels of implicitness. So essentially, we're checking whether the firm also guide on gap. And
That would be very
then,
helpful because it seems
yeah,
in my mind if they have the gap and the special items, even though they're not doing the math to back out those Siri items, the user of the information could get the
yeah,
missing piece. I'd love to hear that when you get to that point. Thank you.
yeah. And Albert has a question.
Yeah, thank you. It might be a little similar to Brett's question too, so feel free to punt it. But while we're on the theoretical framework stuff, I'm just curious, like, to what extent do you think this is like a question of emphasis? Is it like just managers drawing attention to certain line items and just affecting the awareness and processing costs? Or is it actually, do you feel like like changing the underlying information set?
So essentially based on what we find, we think it's more towards managers trying to shift emphasis in the sense that, so we do have analysis on that and it's related to, sorry, let me go to the third. It's related to the third research question, which is about the cost and benefits. So we think because at the end of the day, what we find is those firms, they actually do report actual non-GAAP earnings in the future. So whether they give implicit or explicit non-GAAP earnings guidance, the underlying information does not seem to be changing that much because in the future, there's a non-GAAP earnings being reported about the guided period. But then what is changing is we do see in our last test, firms that do implicit non-GAAP earnings guidance that less likely to receive SEC comment letters related to non-GAAP in the following years. So we think, that would be the benefits of shifting the attention when they do not explicitly mention the non-GAAP label, then it seems that, at least from the regulator's perspective, the oversight is not that strict. Okay, so let me move on. We talked about the research questions, and then at a high level, our study is essentially at the intersection between management guidance and non-GAAP disclosures, and we focus on a fairly novel non-GAAP guidance practice, which we label as implicit non-GAAP earnings guidance. And so I'll just quickly go through the contribution, then we can get to the actual analysis. So we think we contribute to the non-GAAP research by documenting implicit non-GAAP earnings guidance. And we think we contribute to the guidance research in a sense that there are some ideas and evidence bouncing around the literature that management guidance actually has a large variety and it's quite a heterogeneity within the guidance practice. So essentially, with documenting the guidance on individual special items and recurring items, we hope to show just the big variety of management guidance, even when it's related to earnings guidance. It's not only the aggregated earnings, but managers actually decompose the earnings number and give very specific guidance on the individual line items that may impact the earnings. And those guidance practices, they seem to be having an impact on the market participants. And then finally, related to how our study could potentially have implications for the regulators and standard setters, it is quite related to overall the SEC's oversight of non-GAAP disclosures. So essentially, we are detecting an implicit non-GAAP disclosure practice that seems to be skipped by SEC oversight. And we also think we are contributing to the recent debate on the use of alternative performance metrics that the FASB has been quite interested in. in the past couple of years. So even though we don't really directly study non-GAAP earnings guidance in a very explicit way, but we study the component of it, so we think we can contribute to this conversation as well. So now let me talk about just the empirics of what we do. So in order to, yeah.
I'm sorry to interrupt. I think Wei Ali has a question. Yep.
Hi, Xiaoxi. Good to see you.
Hi.
Just wondering, so the specific focus, it's very interesting. I just have a comment around so the coverage of special and recurring items is quite scattered sometimes in the disclosure. Start talking about if there's a major event in the narrative MD&A, and then there's also footnotes where the pieces actually occur in prominence, especially if they relate to contingencies and things like that. So do you intend to, or do you already incorporate sort of those pieces of information and how they finally get corroborated in this guidance? Because users can actually zoom in on those things from other places.
So that's a really good question because it's linked to the data I'm going to talk about. Oh, and Stephen, do you have a question?
Yeah, I'm having trouble with sort of the connection to the non-GAAP earnings literature. That tends to be with metrics which are reconciled to GAAP, okay? And it includes wretched things like depreciation, interest, taxes, stock options, for heaven's sakes. So yours is very different. I would couch this more as guidance on sustainable earnings, okay? And forget sort of those non-GAAP. It is non-GAAP, that's for sure, okay? But what they're trying to do here is indicate sustainable earnings rather than something that's similar to all those adjusted EBITDA type metrics that have to be reconciled to GAAP. You see what I'm saying?
Yeah. So I guess let me quickly address the previous question first related to the disclosure and the guidance data source. So essentially we use a new management guidance data course called LSEG guidance reports, which in fact is the superset of management guidance that IBIS guidance through WRDS is derived from. So what LSEG-GR captures is it just collects all the management guidance from corporate voluntary disclosures like earnings conference calls, earnings press releases. So let's say if we have a case where the firm is going through a major event like M&A, and then it's going to give some guidance related to the acquisition charges, or maybe the firm is going through restructuring and then it issued a press release to explain about the restructuring charges, then the forward-looking information related to those special items would be collected from the press release and be contained in this guidance data set. And this data set is used by professional investors and analysts in real time. So like if they follow a company and they need to say, if analysts need to update their report, they will follow this data set in real time. So it saves them the trouble to collect all the guidance by themselves. They get all the guidance from this guidance reports data. And then this data also includes, the guidance disclosure source. If it's from, press release or maybe conference call transcript, it also contains the underlying disclosure text of a guidance. So then the users would know what exactly managers are talking about. So this is the data set that we're using. So I have another paper that's co-authored with Bill Mayu at Duke and Jetson Pinto at UTD, where we're like systematically introducing this data set. So that paper has more details related to how the data is structured. But essentially what we do is we take the sample of guidance report data for S&P 1500 firms, which ranges from 2005 to 2021. And then this data set has a very broad coverage of more than 1.7 million guidance instances. covering 3 broad categories of topics. So we have purely qualitative guidance, we have consolidated financial statements, and then we have other key performance indicators. So then we zoom into consolidated financial statements, and then we got the list of special items and recurring items. And then Stephen, related to your question about the labeling, I think I get your point. So overall, we don't really think about EBITDA. So our definition of non-GAAP earnings is just, so you have like GAAP earnings, and then there's like a pro forma version of it that sometimes managers, they define by themselves. So we're like focusing on that. So, and then based on that, we have those special items and recurring items where we follow the prior literature on non-GAAP, and then we compile the list. So I guess the most close anchor point for our list of special items and recurring items is the Dichal et al. 2024 paper, which is a non-GAAP paper in Rust. But then, so they have a very big list of all the special items and recurring items. And based on that, we also, acknowledge the other non-GAAP papers where they looked at like the items managers or analysts would often exclude from their GAAP earnings, and then we end up with this list. So to visualize the disclosure for you, I have one example for guidance on special items. So it's from T-Mobile, and for this future period, T-Mobile only provides single guidance on special items, and there's no guidance on non-GAAP earnings per se. So essentially, T-Mobile is given a guidance on merger-related charges, and it's from an earnings call. And the CFO of the firm essentially tells the call participants they can expect merger-related costs with a specific amount that's been guided. And then the next example, which is on guidance on other recurring items, we have Amazon, which is on stock-based compensation. And the guidance happened twice, once in the earnings press release, and then later on in the earnings conference calls, where Amazon is essentially talking about a guidance on its operating income, and then acknowledging it includes impact of certain amount of stock-based compensation. So in both cases, the firm does not give an explicit bottom line non-GAAP earnings guidance, but then it gives some information related to the special items component or recurring items component that sometimes people would consider as non-GAAP exclusions. So that's the data overall we're using. And then we move on to address our first research question, which is to understand to what extent do managers actually provide implicit non-GAAP earnings guidance. And for the S&P 1500 sample we have, and then after merging to other database we need, we end up with roughly 64,000 firm quarters. And within those 64,000 firm quarters, what we see is, if you see on the right-hand side of the diagram, we have overall non-GAAP earnings guidance being given by 36.9% of the sample, which is a rate that's quite similar to what we have from the Call et al. Survey when they ask managers to give non-GAAP earnings guidance. And then if you look at that part of the diagram that's circled out by the red box, essentially this is the portion of implicit non-GAAP earnings guidance. So we have more than 60% of the sample without explicit non-GAAP earnings guidance. And within those 60%, we have 26.4% of all of our sample giving guidance on special items or recurring items. So this essentially means 26.4% of an S&P 1500 sample gives guidance on implicit non-GAAP earnings, which when we consider, it seems to be quite prevalent in a sense that if only 37% of the sample is giving non-GAAP earnings guidance, then 26% does not seem that low anyway. So we think this in practice overall seems to be quite common. Yes.
Hi, Xiaoxi. So I have kind of kept wondering about your earlier discussion about the implications for the SEC and also global accounting standard setters regarding the non-GAAP. But it seems that you have a very rich and very granular data set. But I want to confirm like whether there are two things kind of like in my mind. One is like it seems to be those series guidance may be driven by some unobservable material events that are not observable to researchers, but pretty much kind of potentially driving the underlying motivations for giving those specific line item guidance. And so those kind of like statistics or percentage is kind of capturing the incidence of those events rather than just the tendency or willingness to provide disclosure. And that has a very different implications for regulators or standard setters because that just captures the nature of the arrival of those events. Another related question is, it seems that Siri, when we say line item, we tend to kind of like, as a researcher, standardize a chart of accounts that apply to all the different firms that actually have a different internal chart of accounts and a different nature and granularity of events and also transactions. So potentially we are imposing if more granular chart of accounts that one may not align with individual firms' materiality threshold judgment, and also whether that level of information is available internally were highly related to whether they are able to provide guidance externally. So those are the two things I've been kind of like thinking about since the beginning of your talk. You can address now or later, but I think those are more related to kind of design project, what's the implications of this exercise for those standard setters and then also agencies.
Yeah, so I guess related to the first point, actually, let me jump to the second research question, how we address this. I think this is related to the first question about, those guidance, they could be driven by the significant events that the firm is experiencing. I think overall, I would agree with that statement because so managers give guidance in order to help investors and analysts form future expectations. So if there are significant events going on, then of course that would drive guidance. So I would think that's one endogeneity concern we have in our setting. But I want to say it is part of our story because so we also have as additional analysis, we have like a determinants analysis for why firms give Siri guidance and why firms do implicit non-GAAP earnings guidance. So we do observe that the non-GAAP implicit non-GAAP earnings guidance, they have some different qualities compared to the non-guidance. And then essentially we include those variables as controls. Then what we do in our research design when we think about the information consequences of those guidance, essentially to control for whether a firm is experiencing some significant event that may drive analyst reaction to the guidance. What we do is when we do the analyst forecast revision test, we essentially look at analyst revisions within fairly short windows from before the guidance to after the guidance. So this essentially, to some extent, is keeping the fundamentals unchanged. And then we're just looking at whether the guidance is making analysts to make revisions or not. So this is our way empirically to sort of control for the effect of the fundamental events.
I think a follow-up is like I don't think this is that managers kind of like all the freedoms they have, because I think according to the securities law, they do have to report those material events to comply with the law. And then I think the motivation for my first question is I want to know what's your control group? Are you comparing to firms do not experience M&A transactions or do not give employees stock expense compensations as a control group relative to firms experiencing events? I just don't think that is a comparable benchmark for firms actually experiencing some material activities. Their analysts probably would just respond to that activity relative to another firm that do not experience significant activities during that same period.
I know what you mean.
Yeah.
So I guess a very tight research design would be to essentially restrict the analysis to firms during the period where they experience those significant events, and then we would ideally have some firms with the guidance, some firms without the guidance, and then we compare those two. So what we do right now in our analysis is we are benchmarking the implicit non-GAAP earnings guidance to the explicit non-GAAP earnings guidance. So I think even though we didn't really like narrow down to a very tight sample, but this research design is getting there in the sense that for both implicit and explicit non-GAAP guidance, there's a non-GAAP earnings to be realized. So for both groups, there are some like special items or recurring items that need to be excluded from their earnings.
I think the tighter design would be like conditional on two firms both disclose restructuring cost. Somehow you need to identify the severity of their restructuring activities and then compare within them. Or for two firms that actually both have gone through M&A announcements and potentially that deal transaction relative to the acquires total assets will be one proxy for materiality, so that you are holding constant the nature of event and then comparing across materiality, and then you can say something about is there any discretion over the securities laws compliance that actually we are observing here. Otherwise, the statistics right now represented to us, it can be just random arrivals of those events.
Yeah, I know what you mean. Yeah, thank you. And I think we have another question.
Yeah, so I'm wondering whether the real choice here is not about disclosing the material events, but whether you disclose an alternative income number or not. Because if you disclose an alternative income number, then you have to reconcile. But if you don't disclose an alternative income number and just the items, there's nothing to reconcile.
Yes.
Right? So then should you be comparing those two groups that you had in your picture, right? The non-GAAP earnings group and the Siri group, controlling for the items that are Siri items. Because the choice is really whether you choose to disclose a non-GAAP earnings or not.
Yes.
You're not required to report a non-GAAP earnings, but you are required to disclose material events. So holding the disclosure of material events constant, you have a choice between reporting a non-GAAP earnings number or not reporting a non-GAAP earnings. And that's what's taking you into those two boxes.
Yeah. So later on, when we study the SEC oversight consequences, we do have an alternative sample where the control group is the explicit non-GAAP earnings guidance with Siri guidance. So this essentially is how we're trying to allude to the idea that we want to compare, firms with Siri guidance but no explicit non-GAAP earnings, with firms with Siri guidance but with explicit non-GAAP earnings, because those with explicit non-GAAP earnings guidance, like you said, they need to reconcile, or they need to cite the exemption to say, you know, it's unnecessary effort, so they cannot reconcile. But then that's what is going to attract the SEC's attention in the setting. Right, okay, so let me move on with just describing the second research question and how we address it. So ex ante, when we think about whether implicit non-GAAP earnings guidance would affect analysts' forecast of street earnings or not, the prediction can go either way. So if we believe managers on average, they're giving the individual Siri guidance without an explicit non-GAAP earnings number to convey information about, you know, expected future core performance, then we would expect them to have an impact on analysts' forecast of street earnings. But then on the other hand, the tension here sort of is concentrated in the fact that managers are not explicitly labeling them as non-GAAP exclusions. So then from the information user's perspective, it is unclear if all the Siri guidance could represent non-core activities or, you know, one-time charges that should be excluded from core earnings, because like if there are some significant event going on with the firm and investors or analysts actually believe they could be recurring and they could be, you know, representing a core part of the company's activity, then they would not exclude the Siri item from their forecasting of street earnings. And then one step further from that would be, you know, related to the use of non-GAAP disclosures, but with opportunistic incentives. It is possible that if managers just guide on Siri, but without actually giving non-GAAP earnings and then reconcile non-GAAP earnings, analysts may find Siri guidance opportunistic. And then if that's the case, they might question the credibility of the guidance, and therefore they may not take that information into account. So with this tension in mind, we just move on to empirically test for whether Siri guidance can actually represent implicit non-GAAP earnings guidance. Because so far, our story is essentially building on the assumption that without explicit non-GAAP earnings guidance, Siri guidance just represent future non-GAAP earnings. But we don't really know if this is true or not, because managers are not explicitly reconciling or telling analysts those are the exclusions. So essentially what we do is we have a regression where the outcome variable is if in the future the firm is actually reporting non-GAAP earnings for the guidance period. And then we want to see if guidance of Siri without explicit non-GAAP earnings guidance can predict future actual non-GAAP reporting. And this is essentially what we find. So in the coefficient that's circled out in red, it's essentially showing when managers give guidance on Siri, it's more likely for the firm in the future to report non-GAAP earnings. And this is mainly driven by the guidance on special items. And if we swap out the outcome variable to the magnitude of future non-GAAP exclusions, our results are still consistent. And what's interesting is if we interact Siri guidance with guidance on explicit non-GAAP earnings, so for explicit non-GAAP earnings guidance, there's no incremental predictability. So this means Siri guidance functions as an implicit non-GAAP signal regardless of whether managers issue explicit non-GAAP earnings guidance or not. Yes.
So going back to that earlier point about opportunistic disclosures, do you check if the Siri guidance, which is implicit, is on average more positive than the Siri guidance in the non-gap? So are they excluding some negative Siri items when they don't reconcile? That would be some.
Sorry. So for now, we haven't checked that, but I can see why that would be a very important point. So right now, our conjecture related to optionism, just based on evidence from the prior literature and with sort of borrowing the argument and the reasoning, but we don't actually have any empirical tests that is specifically testing for evidence of optionism. So overall, when we draw inferences from our analysis, we also are quite careful in terms of what we say with optionism. So eventually we're not claiming any of those implicit guiders to be optionistic because we don't really have direct evidence for that. I guess what you're suggesting could be something that we try, because we do see, they have lower SEC oversight, which may be because they're optionistic or maybe not, but we could potentially try to disentangle that. So essentially, we have validated Siri guidance as implicit non-GAAP earnings guidance. So then we move on to test, whether this is influencing analyst street earnings forecast. And what we do is we test for the association between the issuance of Siri guidance and analyst revision of their forecasted non-GAAP exclusions. So the outcome variable here, the revision indicator, is if the analysts revise their forecasted exclusions from before to after the guidance event. And then we also have the guide Siri dummy and then guide explicit non-GAAP earnings dummy to try to understand if Siri guidance is informative, and then if it gets more or less informative when we have explicit non-GAAP earnings guidance. So overall, what we find is when there is an implicit non-GAAP earnings guidance, analysts do revise their forecasted exclusions. So this means on average, analysts find this useful. And what is even more interesting is that this effect essentially get added. So we have an incremental reaction when the special items guidance is accompanied by explicit non-GAAP earnings guidance. So what we interpret from this is that this implies implicit non-GAAP earnings guidance comes with information processing friction, because when it is accompanied with an explicit non-GAAP earnings guidance, then analysts further react to the information. So it seems that when it's just standalone Siri guidance without any information about the non-GAAP earnings, analysts react, but they react less. So that's the information friction we think that's going on here. And then we swap out the outcome variable with the size of analyst revision, and we have consistent result here as well. So this essentially means on average, implicit non-GAAP earnings guidance is associated with analyst revision of forecasted exclusions. Then we try to do some cross-sectional analysis to understand, what's the mechanism going on here. And we have 3 sets of cross-sectional analysis. The first one is we want to understand whether Siri guidance standalone can prompt, like initiate, or is it refining analyst forecast? So if you look at the results here, in columns 1 and 2, we have a subsample where before the Siri guidance, analysts do not forecast non-GAAP exclusions. And then after the guidance, they start forecasting it. So this is what we call the prompting subsample. And then in columns 3 and 4, we have a subsample where analysts already forecast exclusions before the guidance, and they refine. So they revise their forecast after the guidance. And we see results, so we see effect of implicit non-GAAP earnings guidance in both subsamples. So this essentially means there's an effect on initiating analyst forecast, and then there's an effect on refining analyst forecast. And I think we have a question.
Hey, yeah, thanks. It's regarding a comment you made, I think 2 slides before, and I think you were trying to frame the analyst stuff as a information friction story, so maybe processing costs differ and whatnot, if I understood correctly. I'm just wondering, going back to the earlier question I asked about the choice of emphasis here, like in some sense, like managements are making an explicit choice here to emphasize something in either direction, explicit or implicit. So I'm wondering if you want to be a little careful about interpreting this as a processing friction. It could just be that the analysts are meta aware of this choice that the managements make. So they could be actually interpreting this as an additional signal, perhaps about management's intentions about making it implicit or explicit. Doesn't take away from your story. The results are the results, but I think the interpretation should be a little bit, you need to motivate this. If you want to motivate this as information processing friction, I think there needs to be a little more going on here. Just a thought. I don't know if you want to respond to that or anything, but I thought I'd share.
I think I know what you mean. I think so. In terms of how we interpret this result, or like how we label it, so overall, I think I would call it a friction, but I guess based on what you said, we do want to be a bit more careful with calling it information processing friction. So when I say I want to call it a friction, but like then if we don't label like where the friction comes from, I think that would be fine, because what we see in the previous result is that Siri guidance standalone, they can just predict future non-GAAP reporting. And then I get your point about it could be because analysts understand there's something going on. So then unless managers give them the explicit non-GAAP earnings guidance, then they're not fully trusting the Siri guidance. So I guess like one result that's related to this is not this one, but the next one. So we have a cross-sectional analysis where we try to split whether the firm report historical non-GAAP earnings. So the idea here is that if the firm is a non-GAAP reporter, then the analysts of this firm, they should have experience in terms of dealing with this firm's non-GAAP exclusions. So in this case, it is possible that even without the explicit non-GAAP earnings guidance, analysts will understand how to incorporate the Siri guidance into their forecast. And so this is essentially what we find. Like we find when firms disclose non-GAAP earnings in general, like for the historical performance reporting, then implicit non-GAAP earnings guidance just influences analysts more. And in this case, the explicit non-GAAP earnings guidance does not really have any incremental effect. So it seems that this sort of help us to, think about the friction. It could be an information processing friction, because it seems that when the firm has a history of reporting non-GAAP earnings, then analysts know how to deal with it. Then let me quickly go to the second mechanism, which is related to Brett's question earlier about whether firms give GAAP earnings guidance. So this is essentially different degrees of implicit non-GAAP earnings guidance. In reality, like in our data, what we see is among the implicit non-GAAP earnings guiding firms, about 59% of them have Siri guidance with GAAP earnings guidance. So technically speaking, in this subsample, analysts can just take the GAAP earnings guidance and Siri guidance, and then they decide what to exclude and what not to exclude, and then they can compute a non-GAAP earnings guidance by themselves, even though it's not from the managers. And then we have about 40% of the data points where Siri guidance is not with a GAAP earnings guidance. So in this case, it's like really just implicit non-GAAP earnings guidance. They don't even have the GAAP benchmark. And then what we see in the data is that when we have the subsample without GAAP earnings guidance, the effect is there. When we have the subsample with GAAP earnings guidance, the effect is also there. And statistically, they're not different from each other. So like overall, this essentially tells us it seems that the usefulness of the influence of Siri guidance is not changed with the varying degree of implicitness. Yeah, Brett.
Yeah, thank you for answering my question. And this caused me to think about the SEC scrutiny test that you do as well, because I think in the case of guidance, it could also hold true in the case of actual realized number reporting. So whether they, in their realized reports, whether or not they report a non-GAAP number, like Sudipta would say, do they do the math, right? Do they just say we have these material items or a non-recurring item without doing the math, or leave the user of the information to do whatever math they want, exclude or include different items, right? And so I wonder how abnormal it is in the guidance setting based on what it would be in the realized setting for your case.
I don't really have a very clear sense about that, so I'm not going to gauge on this, but I guess this could be something like helpful to look into in the background, or maybe like discuss in the paper, like to provide more details related to the setting. Yeah, thank you.
So in this implicitness test, I think you found the coefficients going in the wrong direction, right? So when it's more implicit, you get a stronger coefficient than when it's less implicit.
Sorry, are you referring to the
Yeah, this table.
Yeah.
Right. So the one on the right is supposed to be more explicit or less implicit. Right?
So the one on the right is with GAAP earnings guidance, so it's going to be less implicit.
So you should expect a higher coefficient because that's what he showed us when he did the non-GAAP earnings versus the implicit. Right? So in this case, it's going in the wrong direction for your implicitness argument.
So like ex ante, we don't really have a very clear prediction in terms of which subsample it would have a stronger effect. And like statistically, we did the test for the coefficient difference. They're not like statistically different, even though one is bigger than the other. And then related to ex ante prediction on this, one possibility is that if they have GAAP, they have Siri, they can back out non-GAAP by themselves. But on the other hand, if a firm is not giving GAAP or non-GAAP guidance, then the information, the forward-looking information that analysts get about the bottom line is just very little. So in this case, it could be the situation where the Siri guidance is really just providing clarity to the analysts in terms of what they should think about when they forecast the bottom line, and then they could potentially just anchor on this and then do the forecasting. So that's like ex ante. It could be a bit ambiguous, and then eventually we didn't really find them to be significantly different from one another.
But I think your idea was that implicitness is related to information processing cost. So, I mean, I think lurking in the background is that idea that the more implicit it is, so therefore, I think this result is going in the wrong direction for you, even if it's not significantly different. If I look at guide RI, for example, I would claim that that difference is significant, even if it's not at the top line. So I think you want to be just a little more careful in how you're interpreting stuff.
So overall, it's like conceptually the argument is not the most consistent with this test. Okay, I get your point. So yeah, so related to the conceptuals, I think we could potentially clarify this more and think about how to make the story more self-contained and consistent. Yeah, thank you. So those are the mechanisms.
You have 4 minutes left.
Okay, perfect, because I'm on the last test. So then finally, what we do is we want to figure out just more broadly what's the incentives behind the practice of implicit non-GAAP earnings guidance. And so we have seen like the cost, essentially what we've seen in the analyst revision test seems to be, friction here. When it's implicit non-GAAP earnings guidance, analysts seem to discount the information. And in terms of the benefits, so when we were talking to the analysts about this whole idea of implicit non-GAAP earnings guidance, then the analysts essentially confirmed, like they could totally see some firms, if they don't want the SEC on their back, they would do implicit non-GAAP earnings guidance. So then they don't have, trouble from the SEC, whether it's just like more work to responding to the SEC, or maybe they have something to hide, which we don't really test. But then essentially we think high level, the benefits here could be lowered regulatory oversight. So empirically, what we test is that the SEC in reality issues a lot of common letters related to non-GAAP issues. And since our conjecture here is essentially by giving implicit non-GAAP earnings guidance, then there's no clear non-GAAP label related to the guidance, then it should lead to less SEC attention, and then the firm would get a lower likelihood of receiving SEC common letters related to non-GAAP issues. And this is what we find. Essentially, what we find when firms give implicit non-GAAP earnings guidance compared to just on average all the other firms, and compared to explicit guidance with Siri guidance, we see the explicit guidance, they have a lower likelihood of getting common letters on non-GAAP issues in the next 3 years. So that's essentially the end of our analysis. And the conclusion is overall, standalone Siri guidance functions as implicit non-GAAP earnings guidance, and it is influencing analyst forecast with some friction. So that's the cost here. And then the benefit here is it helps firm to attract less SEC regulatory oversight. And then at the end, let me introduce to you the next event in the accounting design project. We will have one of the audience members here essentially presenting at the end of this month on a paper about hedge accounting. And thank you all very much for attending this event. The comments are very helpful. Thank you.
Thank you, Xiaoxi. Going to stop recording.